Hey guys, my name is Jan. I'm a co-founder at Exchequer. My background is in quantitative finance, specifically equity derivatives, and this talk is about building DEX liquidity. So let me figure out how do I move the slides up and down. Okay, so let me start by with the problem our ecosystem faces today. For the long tail of projects, the path to liquidity remains problematic. Centralized exchanges are selective and enforce various requirements on the projects. Market makers are not transparent and not cheap, and DEXs impose significant risks on liquidity providers. If we cannot fix this problem, real projects stand to lose ground to meme coins. So let's see if we can make sense of it. And let's first quantify the risks. And the question we want to ask is, what would I pay today to get an LP token in the future? And that blue line over there is an LP token. We can actually come up with a closed form solution for that expectation. And in a risk neutral setting, you can see that the higher the volatility, the lower the price of that token today in the future. That's the orange line. So for LPs, just to break even, you need to overcome that difference, okay? So we've quantified that spread, but it's still there. They're still risky. Can we just get the upside and not the downside? Well, for that, we're going to need options. We're going to need options on an LP, which itself is a derivative. So it's a derivative on a derivative. Well, the first question to ask is, what would a call option on an LP look like? And one example would be the orange line over there. Just like a normal option, only it's curvy on the upside because it's an LP. Well, actually, we are unlucky here. We can actually calculate it in closed form solution. That scale-looking formula over there is a price of a call. We can also do puts. But despite being involved, it's actually very well behaved. It's continuously differentiable. It looks just like it's not much more difficult than your normal Black-Scholes formula, and we know quite a lot about these things. Okay, so now we have puts, we have calls. Let's see if we can come up with a better risk profile for LPs. Take a look at that blue line. On the upside, it looks just like the LP, the orange line, and then it goes flat for the next 75% drop in the underlying token. After that, it goes down. Can we build that? Now we can. It's a zero coupon bond, that's the flat line, plus a call, and then you short a couple of out-of-the-money puts. So what if projects were to issue an ERC20 token that paid that blue line sometime in the future? And what if LPs were to buy that note instead of going directly to the pool? Well, if project were to issue that blue line, they would need to have to pay it at some point in the future. But they can't buy these options because we just invented them. They don't trade, well, yet anyway. So we need to look for something that already exists. Something like that green line over there, which is just a simple LP position, only it's twice the size. So if projects could somehow get their hands on that green line, then that'd be good. Turns out we're actually already there. The green line is equal parts cash and token, and projects have treasuries. So tokens they have. So where does the cash come from? Well, they just sold the blue line. So now they have cash, they have token, and they can establish the green line, and that is going to be the collateral for the blue line. Let's quickly go over the steps. A project issues an LP note. A liquidity provider buys an LP note, gives the project USDC. The project combines USDC with their treasury token, establishing a liquidity position on the DEX of their choice, dropping the resulting LP tokens into the smart contract that is the LP note, locking the TVL, and there we go. So what does this switcheroo get us? Well, LPs, they're protected on the downside, and they have the boosted yield, because that's coming from that green line, twice the TVL. Founders, well, they establish the DEX, liquidity, the pool. They don't have to pay any tokens. Tokens don't get sold by LPs. Now their token reflects the economic value of the project. It becomes investable. AMMs, they just double their TVL. Double because the original LP capital is now complemented by the treasury tokens. With larger TVL, we have lower slippage, lower volatility, increased volume, increased transaction fees, which makes the LP holders, LP note holders happier. So this is an example of a product that we're working on for projects at various stages. For new projects, we are building fair launch auctions that really determine the price of the auction. For existing projects, we build DEX liquidity. For mature projects, we're creating products that let treasuries and DAOs sell their treasury tokens without steep discounts. Thank you.
You hear me? Brilliant. Lovely. Thank you very much, Jan. Fantastic presentation there. I have lots of questions. Does anybody from the audience first have any questions they'd like to ask away? Oh, okay, brilliant. So just one question for me. As someone who's like very deep in kind of DeFi, I love the fact that you're finally giving an option where there will be utility for the DEX token. Why do you think that model needs to come? Right now, the crypto market doesn't really appreciate the DEX governance tokens. In your vision, how do you see that transition can happen for DEX token holders and DEX projects teams?
Well, really, this slide, what's happening is the ecosystem has become much more sophisticated. The projects have now matured and are now little companies. And companies are served by investment banks. And the founders who originally sort of started building the system, they don't know how the financial world works with TradFi. And so we need sophisticated tools. What we need to do is we need to realign the interests of all the people, all the participants. What's happening now, LPs are serving two functions. They're providing capital and they're taking on the risk. So what we're doing here is separating the risk from the capital and moving that risk from the LPs to the projects. And it turns out that it's a lot cheaper. So we just need to figure out at where the risks are, quantify them, figure out who wants a particular risk, who does not want it, and therefore overcharges for it, and then we'll be fine.
Lovely, thank you very much for that.